One of the most important steps to trading price action is your ability to identify and follow the trend. The reason this is very important is because as retail trader that you and I are, we don't have enough capital to even move a single 1 minute candle in the market. So we basically or solely rely on the big boys in the bank, that is the commercial banks, the hedge fund, the institutions, to pour in their liquidity, and we try to study their footprint and trade along with them. And that is what I basically call as trading along with the trend. Take, for example, when you come into the market with a particular price, with a particular strategy, be it smart money concept, ICT concept, support and resistance, engulfing candle, name it, whatever strategy you come into the market with, the core aspect of that strategy is the ability of the trader to use that strategy along with the trend. One of the major issues I used to have then, and I've noticed it over time with the newbies, is you are having the right strategy, or you are trading the right strategy, but in the wrong market. And this is one of the ways to keep blowing accounts and along the line get tired of the market and possibly quit or becoming frustrated while trading. So in today's lesson, I'm going to dive into some of the key concepts for you to imbibe or incorporate and start trading that strategy you're having profitably with the trend in the market. So if you are a returning subscriber, thank you for always being supportive. And if you're new to the channel, please consider subscribing, turn off the notification in order not to miss the upcoming content that will be released. And without much ado, let's dive into it. All right. The number one steps in trading price action profitably in the market is you don't start your analysis on your entry time frame. That's the very core rule. Do not start your analysis on your entry time frame. Take, for example, looking at the chart, for example, in volatility 25 index, you can see that the market is purely trending down, right? The market is purely trending down because we have a higher low, a lower low, lower high, lower low. And the market is between this range and this range, and this level and this level here. So it's purely trending down. But if you scale up to the higher time frame, for example, or the higher time frame, the daily time frame, for example, let's get up to the daily time frame, you will notice that the market structure has actually aligned here and the trend is up on the higher time frame. So being on the lower time frame, you would definitely be making a wrong decision trying to sell. Meanwhile, the price action is what telling you to buy on the higher time frame. So the trend is up. That's it. Do not start your analysis from your entry time frame. Rather, start from what? A higher time frame. And in this case, I use daily time frame as my higher time frame. And you can use the weekly time frame or the monthly time frame as your higher time frame. But I recommend daily time frame as a day trader. Then, after you've identified the trend on the higher time frame, you want to scale down to the 4-hourly or the 8-hourly time frame. And what you want to do on the 4-hourly or the 8-hourly time frame is to basically read the details of the price action on the what? This lower time frame. That is the structure of the market. And when it comes to the structure of the market, is basically when the buyers are much in the market, price keep trending up and the higher highs are targeted. That's the trend. And when sellers step into the market, the direction of the market change and it begins to what? Trend down. So basically, in this particular price action, we want to be, it's in our best interest to be a buyer. And if in this particular price action, it's in our best interest to be a seller. So what we want to do on the 4-hourly or the 8-hourly time frame is to read the details of the market. That is, try to read the price action of the market. And you can see that sometimes when you're in a daily time frame, the price action, the direction is up. You come to the 4-hourly time frame, price action might be down. Take, for example, if you're in the market from this particular zone, you'll definitely be seeing it as a downtrend. Not until you get to this point and there's a realignment on the chart. And you can see that from here, price start trending up. Right. That's when you can trade in line with the trend. So after you're done reading the details of the market, take for example, we have a higher high here and a higher low. So we are expecting this market, as it has pulled back, to go up to take out this what high here. Right? But if you're on the lower time frame, that's the 15-minute time frame, you will see that it will be like you should be selling rather than what? Buying. But when you look at the daily time frame and you read the details on the 4-hourly time frame, it is your best interest as a day trader to what? Be a buyer in the market. Okay. So once you are done reading the details of the market, take for example, let's use this particular price action here. Sorry. Let's use this particular price action here and here, for example. We've identified from the higher time frame that the price action is what? Up. And scale down to the, let me say, intermediate time frame, the 4-hourly or the 8-hourly time frame, and we've read the details of the market, that the structure has actually aligned with the big picture or the higher time frame. Then we scale down to our entry time frame. In my own case, I use 15 minutes as my entry time frame. And what I want to do, I want to make sure that this lower time frame is in agreement with the intermediate and the what? The higher time frame. And you can basically do that by understanding what change of character is. And we've taught in this channel over time what change of character is. If you're new to the channel, please, I will link up a video in the description or anywhere within the screen. Probably if you don't understand what change of character is, go and study it, come back for this lecture so that you can get full knowledge of it. What we want to do here is to basically identify change of character. And you can see from this particular zone here, what happened here? The market realigned here. With the price action was basically trending down. You can see creating lower low, lower high, lower low, lower high, lower low, lower high, lower low. And there's a realignment here. Once we have a realignment, we say we look for what? The next imbalance, and we place our trade. Market failed to come back for this particular level here. Let me remove this extension. Market failed to come to this particular price action here, but you can see that at the same time, trend line. You can see price action trending down. What happened? There's a realignment here again, or a change of character here. Map what? The imbalance here. You can what? Now execute your trade, your long position, or whatsoever, and target what? The next impulsive high. Right? So you don't start your analysis from the higher time frame, and once you're done with the higher time frame, scale down to what? The lower time frame, the intermediate time frame. What you want to do, read the details of the price action on the intermediate time frame. Then you scale down to what? Your entry time frame. Then look for what? Your execution, your entry model, or what you look for, what you consider before entering the market. That's your entry criteria. So this is the best way to trade, in my own interest, to trade along with the trend. Okay, just for a recap. Start your analysis from the higher time frame. That will give you a big picture of the price action and what the big boys are actually doing in the market. Scale down to your intermediate time frame, or the 4-hourly or the 8-hourly time frame. Read the details on those particular time frame. What I mean by the detail is the structure of the market, whether it is in agreement or in alignment with the higher time frame or not. Once it is in alignment with the higher time frame, you can now scale down to the entry time frame and read what the structure still on the entry time frame for it to be in alignment or agreement with the overall higher time frame. This is the only way you can trade any forex strategy profitably in the market. sometimes when you're on the lower time frame, the higher time frame might be trending on while the lower time frame might be trending down. You will know, or you already have the understanding from the higher time frame, and wait till when the lower time frame realign with the higher time frame, and you can trade along with the overall trend on the higher time frame. That is when your strategy will perform exceptionally well in the market. Please don't think the strategy you're actually trading is wrong. You are possibly or probably using it in the wrong way. So that is all for today. Don't forget to like, share, comment, subscribe, turn on the notification, and until next time, keep practicing. Peace out.